Hello, today we are going to talk about Chapter 18 in Managerial Accounting. We are covering cost behavior and the cost volume profit analysis. So just like every other chapter in Managerial Accounting, we are going to focus on the manager's side, the internal accounting for this chapter, so we can make the best decisions as managers. So the first thing we're going to talk about is the CVP, or the cost volume profit analysis. This is exactly what it sounds like. We're looking at the cost based on the volume of the product that we're producing and how much profit we can make off of that. So managers will use this to predict how changes in cost and sales levels will affect their profit. So there are 4 different inputs that we need to determine before we can calculate the cost volume profit. The first one is the number of units that are sold. That's super important, along with the price per unit. That's things we have to know in order to know how many we should produce and if it's worth getting into the fixed costs that we're going to have to face. Then we have our variable and our fixed costs. So these are all super important for us to know. And I know you're already familiar with most of those concepts there, but let's just talk about a few terms before we go any further. So first we have the relevant range of operations. This is under normal business operations. This is how many we would typically produce and sell. So that's our relevant range of operations. You already know what a fixed cost is. That's anything that does not change with the volume of activity. So no matter if we produce 100 units or 100,000 units, we still have to pay the same amount in our insurance, the same amount for our rent, and so on. Variable, you know that we do have different costs that will change in proportion to the volume that we produce and sell. So if we are making bicycles, you are going to have 2 tires and for every bike. And if you make 100,000 bikes, you're going to have 200,000 tires. If you make 10 bikes, you're going to have costs for the 20 tires. So variable costs change with the volume of activity. Our mixed cost, that's something new, is going to include a fixed aspect and a variable aspect. So if we were to look at how total fixed costs look, it doesn't matter what the volume is, it doesn't change. Volume for the variable is going to increase the cost. Mixed has that fixed aspect and it has the variable, so it's never going to be 0, but it will increase with the volume. So a good example of this would be like a commission for a sales rep. So the salary they get would be the fixed cost, the commission would be the variable aspect. Or it could be your gas bill. For me, even if I don't use any gas, because for my house, I only use gas for the heat, I still have to pay like a $10 fee every month just to keep the gas on, just to have that available if I were to want to use it. So the $10 a month I have to pay to keep it on is the fixed cost, and the variable is when I actually use it. The volume that I use that at is going to increase the cost. So here's how it can look all together. If you have fixed costs for your factory of $32,000, it's going to be the same whether you make 0 items or 1,600 items. It's going to stay at $32,000. The big difference is how we can spread it across the different products. We'll look at that in just a second. The variable cost, it tells us, is $20 per unit. So if we don't make any, we have $0 in variable costs. We'd still have the $32,000 in fixed, but 0 in variable. And as we produce more and more, our costs increase. So every one that we produce, we're going to have an extra $20 in cost. And whoops, I should have finished this here. Okay, apparently I'm going the wrong way. There we go. So the mixed cost aspect is going to start at the fixed cost, the $32,000, and increase by $20 for each product. So let's look at this little chart here. This is just taking that same information, breaking it down. If we produce 0 units, we still have to pay the $32,000 in fixed costs, but we would have $0 in variable costs. But if we make 2,000 units, We still only have the 32,000, but now we have 40,000 in variable costs since each of those 2,000 units cost us $20. So 20 times 2,000 would be 40,000. So if we make 200, our total cost would be the fixed cost of 32,000 plus the 4,000 in variable cost. So we'd have total of $36,000 in our product cost. We get to spread that out amongst 200 items. If we make 2,000, we're going to have $72,000 in product cost, and we would spread that out amongst the 2,000 units. Another way to look at the same information is the cost per unit. So here we're not looking at total cost like we were on the last chart. We're looking at the cost per unit. Our variable cost is $20 per unit for every single unit. Our fixed costs go down per unit as we produce more and more. Let me show you what that looks like in this chart. If we produce 1 unit, it's going to cost us $32,020 to make that 1 unit. I hope we are selling very expensive items. Maybe we're selling a nice sports car. But the fixed cost can only go towards however many units we produced. If we only produce 1, we got to make up those costs from that 1 product. And we only have $20 per unit in our variable cost. If we make 400 units, we get to take the 32,000 in fixed cost, divide it by the 400, and we would assign $80 to each unit for fixed cost, and of course, our $20 per unit for variable. So our per unit cost decreases because of the fixed cost getting allocated or spread across many more products with the more volume that we produce. But our variable cost per unit will be the same regardless. So here's some different expenses that would fall into these 3 categories. We said fixed cost can be rent, can be property taxes, depreciation, variable costs. We know all these things that vary with volume, and mixed costs. We talked about a sales rep. We talked about gas. Could also be the same with electricity, water. When I pay my water bill, there is a sewage aspect to that. We're paying the city for using their sewage, even if we didn't use any water, but then they add on how much we used in water as well. So that's that mixed cost. So those are just some examples. All right, a stepwise cost. This one's interesting because this is not a cost like a price per unit that goes up steadily. This would be something like maybe a supervisor. Okay, for every 20,000 units we produce, we're going to need 2 supervisors that make 20,000 a year. So we got a total of $40,000 in costs. They're fine as long as we keep making 20 or 30 or 38, 39,000. But once we hit that 40,000 units that we're producing, we're going to need to hire another manager. And then those 3 managers can handle it. They can handle it until we reach 70,000, or maybe this is more like 65,000. Then we're going to need to hire another manager. So that's the stepwise cost. It doesn't just evenly go up. It goes up, all at once because we need to add something. Maybe is that we need to add another delivery vehicle once we reach a certain number of deliveries we make. Or maybe we need to add another machine based on how many we're trying to produce. So that would be what a stepwise cost is. Curvilinear is kind of similar, but it doesn't just go up all at once, but it's not a steady incline either. It just goes up at a non-consistent rate. So that would be a curvilinear cost. There's a lot of economics in this chapter. A scatter diagram. So you've probably seen this before in a different class, but a scatter diagram is where we have our estimated cost outlined here. We have the line drawn for what our estimated costs would be. And then we put different points on the graph for what the costs actually were. And then we look for any outliers like this guy over here in October. Why was that one so much less in costs than what we expected? And then we would dig into that. So when we do a scatter diagram, we're looking for outliers from what we expected, that reference point, to see, what do we need to look into. All right, this is not a very challenging calculation, but this is the main calculation, the biggest calculation that you are going to have to account for in this chapter. So the high-low method. We are going to use the highest volume point along with its cost and compare that to the lowest volume level and its cost to figure out what our variable costs are and then what our fixed costs are. So I'm going to show you these 3 steps, but really we're going to walk through it, and it's a lot easier, I think, to walk through it than to just read through it. But I'll tell you the first step is we are going to identify what was the highest volume level, what was the lowest volume level. So probably by months, which month did we do the most volume? Which month did we do the least amount of volume? Then we're going to find the slope. That sounds very much like economics, doesn't it? And that will help us to figure out what the variable cost per unit is. And then we are going to use either the high or low to subtract those variable costs, and the difference will be the fixed cost. So let's just go ahead and look at an example. Here we have 12 months of the year. The first column for each one shows us the units they produced. The second shows us the total cost. So we have here, we're going to look for the highest month. Looks like November had the most units produced, 67,500. And then we're going to look for the lowest. And that would be June. June, they only produced 17,500. So we're going to take the highest volume, 67,500, minus the lowest volume. And they made an extra 50,000 in November. Then we find the cost that is associated with those. In November, the cost to produce the 67,500 was 31,000. We're going to fill that in down here for the cost for the highest month. Then in June, when they produced 17,500, it cost them $18,500. So the difference would be 12,500. So remember, we have our 50,000 extra units that were made in November compared to June, which cost an extra $12,500. That tells us that extra $12,500 must have been related to variable cost. So we're going to take the change in cost divided by the change in units, which this is what we did down here, 67 minus the 17 to get 50, 31 minus the 18 to get 12,500. We divide the change in cost by the change in units, and that tells us our variable cost per unit. So for this example, the variable cost was 25 cents per unit. Finally, our last step is we want to find the fixed cost. So we can use the highest point and the highest amounts, or we could use the lowest. Either way, we are going to come up with the same fixed cost. So in this example, we're using the highest. So we said the highest cost us total dollars of 31,000. And then that's going to equal our fixed cost plus our variable cost times the number of units. We know our variable cost was 25 cents times the 67,500 units that they produced in November. So 25 cents times the 67,500 means that we spent $16,875 on variable costs. That must mean the difference is the fixed cost, which was $14,125. You could have plugged in the total low cost and the total low units, and we still would have come up with the same fixed cost. Here's how it will look in your homework. We have June through December. We're going to find the highest units produced, which is November, minus the lowest, which is December. The difference is 180 units. Then we're going to compare their prices. 10,400 minus 4,100 gives us $6,300 in difference. When we divide those, we're going to come up with a variable cost per unit of $35. Then you're going to fill it in with the high point, and then we're going to do the low point so we can compare it, make sure it reconciles. Total cost at the high point was 10,400. We produced 230 units at $35 each for variable cost. When you multiply those, you get $8,050. The difference between the total cost minus the total variable tells us the fixed cost. Same thing for the low method. It cost us $4,100 to make 50 units. That was $35 in variable cost each, which totaled $1,750. The difference between that variable cost we just calculated from the total cost is, again, $2,350, which is our fixed cost for every single month. So that's the high-low method. That really is the hardest calculation in this whole chapter. But now we're going to look at several other formulas. The first one is a contribution margin. We are going to hear contribution margin for several chapters, so really try to remember this one. This is the selling price minus the variable cost per unit. Selling price, if you want to do it per unit, selling price per unit minus the variable cost per unit. That is the contribution margin per unit. So how much is left over for fixed cost and for some profit? Then, very similar, after we've calculated the contribution margin per unit, we divide it by the sales price per unit to get the contribution margin ratio. So the percentage of a unit selling price that exceeds the variable cost per unit. So our example here is the selling price per unit is $100 minus the variable cost. Our contribution margin per unit is $30. When we divide that by the selling price per unit, we get a contribution margin ratio of 30%. Our break-even point, how many do we have to sell to cover our variable and our fixed cost without any kind of profit, without any loss? So this is our break-even point in units. Then we'll look at break-even point in dollars. So our fixed cost divided by that contribution margin per unit. We had calculated that was $30. Now they're telling us the fixed costs are $24,000. So that tells us they need to sell 800 units per month, which at that point we would say, okay, can we actually sell that many? If we can, maybe this is worth it. Well, we still want to make some profit. If we can't, then maybe we need to figure out a different way to find somewhere else to rent or have less in fixed cost in one way or another. The break-even point in dollars, we take our $24,000, our fixed cost, divided by the contribution margin ratio, and that is going to give us our fixed cost in dollars. Next is our break-even point. We are going to, next within the break-even point is going to be the contribution margin income statement method. So here we want to take our sales minus our variable costs. That gives us a contribution margin. Then we subtract out our total fixed costs, and that brings us to our income. So this example, this company has fixed costs of $442,200. Their single product sells for $189 per unit, and then their variable costs are $123 per unit. The company expects to have sales of $10,000 or 10,000 units. So what is their contribution margin income statement? All we have to do, we filled in the fixed cost, they gave us that amount. The sales and the variable, we take the per unit and we multiply it times 10,000 units. The difference is the contribution margin. And then when you subtract out those fixed costs, you're going to get the net income. This right here is just going to show you the cost volume profit chart, the break-even point. If you don't sell enough to break even, you have a loss. If you sell more than that, then you have a profit. That break-even covers your fixed and your variable costs. A couple more things we'll look at here is the margin of safety. And then we're going to look at our target income. We'll be done with chapter 18. So our margin of safety, we're going to take our budgeted sales. So now that we know how much we need to sell, let's figure out how much we think we could actually sell and go from there. So we take our budgeted sales minus our break-even sales divided by our budgeted sales. And that tells us what our margin of safety is. So, okay, we actually think we're going to sell way more than what we'd have to. So that's great. We should continue on. If you end up with a really small margin, that means, yeah, you probably are going to cut it close on making any profit. Our final formula for this chapter is the dollar sales at a target income. So we want to figure out, okay, I know what my fixed costs are. I know what my variable costs per unit are. I know what I'm selling it for, but I want to make sure I make at least X amount of dollars to make it worth my time. So in this one, we say, if we take our fixed costs plus our target income, how much money we want to make after everything's said and done, divided by the contribution margin ratio, how much am I actually going to have to sell to reach this target? It's not even worth it to me if I don't reach this target. So we took our fixed cost. They wanted to make at least $12,000 divided by that contribution margin ratio. They said we have to make at least 120,000 in sales. So at that point, they decide, is that realistic or not? So hopefully you found this chapter to not be too challenging, but you can always reach out to me if you have any questions.